So, what drives innovation? In a research paper titled by the same question, Harvard professor Tom Nicholas argued that the regulatory policies should reflect the changing nature of innovation. But pinning that down, that is, what drives innovation, isn't a simple task. Scholars at the intersection of law and economics have long grappled with that question. And so far, there's only some very broad generalizations that appear possible. Airfox and Paragon, two companies at the center of a new technology, found themselves at that intersection. They were in conflict with the law when they issued an initial coin offering, an ICO, that was in non-compliance of existing rules governing the sale of securities. They precipitated a vigorous oversight by the United States Securities and Exchange Commission who were determined to enforce existing laws, and regulators are intending to guarantee themselves as the legal middleman to protect its citizens in the contract laws of the United States. So how could Airfox and Paragon and other fintech companies have erred so recklessly? Were they innovating, or were they defrauding their investors? Since the Howey case in 1946, security laws have been clear in their definition that many of our instruments in today's commercial world fall within the ordinary concept of a security. They embody a flexible rather than a specific principle capable of adapting to countless variable schemes that may appear in the future. Whatever a public contract or public law require, people don't always follow the rules, and they don't always agree to what the rules actually require. So these fintechs likely depended on their mistaken theory that a DAO was a viable concept to be not registered with a state entity. Due to its sometimes anonymous and non-registered corporate state entity structure, a DAO does not preclude registration like any other conventional corporate entity. But due to its lack of traditional governance by public law, a DAO, or smart contracts and ICOs, or currency offerings, can easily cross many legal jurisdictions, even within seconds, with impunity often misconstrued. So entity governance is essential to contract law, economic governance, and taxation. So there's little confusion that the SEC sees a broad and flexible defense of those principles as its core duty. This is going to keep fintech innovators mindful, and the regulators aren't far behind invention. In fact, as far back as 2013, the agency has published repeatedly guidance in jurisdiction and enforcement where the interest of entities owned by virtual currencies, or that they were providing returns based on assets such as virtual currencies, regardless of whether they were or not underlying themselves as a security, were going to be considered as such. So should Airfox and Paragon should have been immediately or imminently aware that they had potential legal peril, and deservingly, I think they're going to pay a heavy price with government fines and shareholder claims. Moreover, the legal community has raised questions that the DAO could overlap crowdfunding capabilities and run afoul of security laws in several countries. The value of a decentralized organization in a global market requires that the U.S. legal system oversee these entities. This is an important signal because it's the U.S. that's setting a precedence for the rest of the world to follow with respect to fintech regulation. For fintech innovators, regulatory compliance becomes a central part of their business risk. And as the market matures from its wild, wild west nature of invention, it's going to have to carefully consider how it's going to operate in the world. Regulators are moving swiftly to engage innovators. They're looking at intersection of laws and economics, and they are looking to fight fraud in the virtual currency markets that dovetail multiple agencies, such as the Commodity Futures Trading Commission, where the SEC and has jointly issued several statements together to affirm the joint commitment in fighting fraud. In doing so, these agencies have left open the possibilities of overlapping jurisdiction in certain cases. So where is the fintech to look for solutions in innovating? and where are the appropriate balances between invention and governance. So to remedy this, the SEC has stepped up its guidance and advisories to the industry and their legal teams. Specifically, there are 4 central focus areas for observation: blockchain and distributed ledger, digital marketplace financing, automated investment advice, and artificial intelligence. It offers a comment and advisory services to help Fintech understand its strategic direction and future areas of observation. There's little reason for a Fintech at this point to misstep. Ultimately, the SEC is seeking to promote financial innovation, capital formation, and wealth creation, but in balance with consumer protections. So where we look at conventional registration and security laws and they providing oversight, there's a simple yet eloquent solution at that intersection of law and economics that Professor Nicholas describes and that the Supreme Court affirmed. Registration is a principle in practice since 1946.